Hi, I'm Rick Ashburn, Chief Investment Officer of Creekside Partners. If you watched our introductory video, you know that we are devoted value investors. As such, we're constantly evaluating the stock market to determine what we think is the fair value. There are two key inputs to this. One, a reliable forecast of the amount of money these companies will make over the long term, and a decision about the rate of return that we want to earn and that future investors will want to earn. I can best illustrate the fair value concept by using rental property as an example. Let's say you're thinking of buying a rental property. You decide the fair rate of return on your money is 8%, since that is what rental properties have historically earned. You want that 8% because it's both fair to you and it's what a future buyer of your building will also want. It would make no sense to assume that future investors will be willing to accept a lower rate of return than what you want today. This is a very important point. And you need to make this decision before you even consider specific buildings. If you go out and find a building that earns $10,000 a year in rent, the fair value is $125,000. You need to make this decision about fair return before you even consider specific buildings. If you go out and find a building that earns $10,000 a year in rent, the fair value is $125,000. The $10,000 in rent equals 8% of that purchase price. You would be willing to pay $125,000, and you have every reason to believe that someone else will come along later and be willing to pay the same. So let's say then you go shopping for buildings, and you find one that earns $10,000 a year, but the price is $150,000. The investment return is now only 6.7%, not 8%. You would be making less than what you think is fair. If a future buyer of your building does insist on 8% instead of 6.7%, you're going to sell the building for less than you paid for it and lose money. This rate of return figure at the heart of our fair value analysis can be stated in two ways. Real estate investors would call that 8% figure the cap rate. It divides the income by the price. In the stock market, the convention is to turn that ratio upside down and put price on top and earnings on the bottom. This is the familiar price-earnings or PE ratio. A cap rate of 8% is the same as a PE ratio of 12.5. In our next video, we'll talk specifically about the stock market in detail. In particular, we want to talk about how to estimate future earnings and how to determine the fair value of stocks.